Welcome to the Deep Dive. Today we're venturing into the really high-stakes world of trading. It's a place that promises incredible wins, but also, well, devastating losses.
Definitely. It sparks a lot of curiosity.
Right. And for you, the learner, listening in, we want to unpack some of its complexities, give you some real insights, but, without getting bogged down in too much jargon.
Exactly. And to do that, we've really dug into a fantastic first-hand account, Pitbull. Lessons from Wall Street's Champion Day Trader by Martin Schwartz. This isn't theory, not abstract stuff. It's the gritty reality, someone who really battled his way to the top.
So our mission today is to pull out those key lessons from Schwartz's early days, how he formed his trading philosophy, the actual practical steps he took on that journey from analyst to floor trader.
Yeah, getting onto the MX floor.
Okay, let's get into it. The book kicks off with a really powerful moment, doesn't it? Schwartz's first day trading options, right there on the Amex floor. He's looking at Mesa Petroleum.
That's right. He's thinking about buying 10 October 65 call options. They were $300 each if the stock hit 62 and a quarter.
Okay, hold on. For anyone maybe less familiar, what exactly is a call option here? And the strike price?
Right. So think of a call option like a down payment. It gives you the right, but not the obligation, to buy 100 shares of a stock, Mesa, in this case at a specific price.
Which is the strike price.
Exactly, the $65 strike price here. And you have until a certain date, sometime in October, to decide.
So he's basically betting Mesa's stock will climb above $65 before that deadline.
Precisely. The hope is to buy at $65 using the option and then sell the shares immediately at the higher market price for a profit.
Gotcha. So he's there on this buzzing floor. Can you paint a picture? What was the Amex floor actually like back then? Late 70s, not like today's screen-filled rooms, I imagine.
Oh, absolutely not. Imagine a space like almost the size of a football field, huge ceilings, several stories high, just constant noise, constant activity. And instead of screens, you had these big horseshoe-shaped stations. That's where the specialists worked. Guys like Chicky, Franny, Donnie, he mentions them.
Specialists?
Yeah, they managed the trading for specific stocks or options. And behind them, these giant racks, almost like old post office boxes, pigeonholes, holding physical paper order slips for every stock, every option, strike price, expiration date.
So actual paper tickets.
Yeah, very physical, very hands-on. Traders, brokers, clerks, constantly moving, shouting orders, scribbling notes. Intense.
Sounds incredibly intense,
Yeah.
almost. Yeah, tactile is the word. And Schwartz is about to jump into this chaos.
Yeah.
But it wasn't just a random impulse, right? His wife, Audrey, played a big part.
Oh, massively important. Audrey was instrumental. She saw his drive, saw his potential, but also, saw how unfulfilled he was working as a securities analyst.
Right.
She really encouraged him, pushed him to go after this dream of being his own boss, reminded him he had his education, something solid to fall back on if it didn't work out.
That encouragement must have been huge.
It was vital, gave him the courage to actually take that leap.
Because he was clearly feeling ground down by the analyst role. All the travel, the, as he puts it, kissing ass, just to get commissions for the firm.
Exactly. He hated that feeling, the lack of control, the sort of superficiality of it all. He craved independence.
Though he also felt pressure from his parents, didn't he, to achieve that kind of traditional success?
Yeah, that was there too. But then, okay, he's ready to make this Mesa trade, his first big one, and the stock price starts to dip, down to 62 3/8.
Oof. First trade nerves kicking in.
You can just imagine that wave of doubt, right? That uh-oh moment.
For sure. That tiny move against him must have felt huge. But he doesn't back out. He calls his mentor, Bob Zollner. Tell us about Zollner.
Zollner was, in Schwartz's view, the best trader he knew. Especially brilliant at something called tape reading.
Tape reading.
Think of it like watching the ticker tape, but really analyzing the flow of orders and trades coming through, trying to get a feel for the immediate supply and demand, predict those very short-term price moves.
They'd met earlier at a smaller firm, Edwards and Hanley. Zollner was apparently a master at shorting stocks, too.
Shorting, betting the price will go down.
Exactly. He just had this knack for understanding market psychology and timing.
A really seasoned guide, then. Now, the book doesn't say exactly what Zollner told him on that specific Mesa call, but his influence must have been there. Because Mesa keeps sliding. 61 7/8, 5/8, down to 61 1/2.
Right.
And Schwartz, he buys more calls. That seems counterintuitive.
It does, doesn't it?
Yeah.
But it probably speaks volumes about the trust he was starting to build in his own developing methodology, and maybe a bit of that gambler's instinct he talks about.
Sticking to the plan.
Yeah, she had a plan, and maybe Zollner's mentorship had helped instill that discipline. You know, stick with it even if the first few ticks go against you. Not every trade starts out a winner.
That takes guts, especially a first time on the floor like that. He even quotes his bids to Chicky, the specialist. 2 and 9 for 20. What's 2 and 9? Right. Before everything went decimal, prices were quoted in fractions, often down to sixteenths of a dollar.
Sixteenths? Wow.
So 2 and 9/16 is $2.09. That's $2.5625 per option contract. And he wanted 20 more contracts at that price.
Okay. And then things start to turn.
They do. The market shifts. Mesa stock starts climbing, hits 63 3/8. Suddenly, those options he bought look really good.
The energy must have shifted completely.
Totally. The pit gets even louder, more chaotic. You hear the bids flying. 3 to a quarter, 50 at a quarter. Escalating noise, escalating tension, and Schwartz is right there in the thick of it.
And then he decides to sell. There's that colorful story about the Merrill Lynch guy.
Yeah, the spitting incident. It definitely highlights just how raw and competitive that floor environment could be. He shouts, SLD, gets his price, and yeah, there's that intense, almost aggressive moment.
He really paints a picture.
And then the pit clerk confirms it, stamps the ticket with Schwartz's number, 945, done deal.
And the result, first day, first trade.
An $8,000 profit?
Wow, just like that.
He describes it as just this incredible feeling, liberation, like winning the lottery, he says. Realizing a piece of the American dream. No more analysis grind.
A powerful start. But, like you said, it wasn't luck. This was a plan coming together. Let's unpack how that plan actually started.
Right, because that initial excitement, that first win, it was built on a foundation. He contrasts it with those memories of being an analyst and the endless travel, feeling stuck.
And it was conversations with Audrey that really sparked it.
Yeah, they started talking seriously. How could he make this happen? How could he become a trader? And that led to the very first crucial step they identified.
Which was?
Develop a methodology for trading that fits my style. Capital letters in the book emphasizing how important it was.
So not just winging it, they needed a system.
Absolutely. They started digging in, looking at barons, clipping coupons. Remember coupons for market newsletters, charting services, just doing the homework, learning different approaches.
Well, and figuring out the money side too, right? The grubstake.
Yeah. They calculated what he'd realistically need to make the switch. Came up with that figure. $100,000. His starting capital.
And they also knew mentorship was key. He mentions legends like Michael Marcus at Secoda.
Yeah.
But he zeroed in on Zollner. Why him specifically?
It was that tape reading skill. Schwartz seemed to understand that while big picture analysis mattered, reading the immediate market action, those subtle clues in the order flow, could give him a real edge as a floor trader making quick decisions.
Zollner had that specific skill he needed.
Exactly. That real-time interpretation was gold.
Another part of the plan, getting a seat on an exchange. What were the advantages there? Seems like a big hurdle.
Huge advantages. First, costs. Members traded at much, much lower commission rates, sometimes called market maker margins or triple M's, way better than what the public pays.
Because they provide liquidity.
That's part of it, yeah. Always buying and selling. Second, leverage. Seat holders often got better margin requirements, meaning they could control more capital with less money down.
Amplifying gains, but also losses.
Absolutely. Leverage cuts both ways. Big advantage, but needs careful handling.
Okay, so lower cost, more leverage. Then this Terry Laundrie guy and his magic tea theory come into play. Sounds intriguing.
Laundrie was this fascinating MIT grad, kind of an unconventional thinker about markets. His magic tea theory basically suggested the market spends roughly equal time going up and going down.
Equal time.
Yeah, and he talked about this cash buildup phase before big upward moves, a sort of consolidation period. Schwartz found this cyclical view really interesting.
Did he just, adopt the magic tea wholesale?
No, not at all. That wasn't his style. He took the core concept, the cyclical nature, and then he blended it, synthesized it with his own personality, his more mathematical mind.
Made it his own.
Right. He tested it, adapted it, kept what worked for him, discarded what didn't. And combining that with Zollner's practical insights, he started seeing results.
How so?
He began trading options on solid, well-known companies, Syntex, IBM, Honeywell, stuff like that, companies with good liquidity. And he focused on scalping.
Scalping.
Yeah, aiming for smaller, quicker profits, getting in and out fast, targeting maybe $1,000 to $3,000 per trade. Lots of small wins adding up.
Okay, so the methodology is developing, the plan's taking shape, but actually getting onto the MX floor was still a step away. How did he manage that?
Connections helped. He knew an analyst, Bob Friedman, and Friedman's stepbrother was Danny Weisskopf, who was a specialist on the MX.
Ah, specialist again. Key people.
Very key. Weisskopf was apparently swamped, super busy, so he passed Schwartz along to Hayes Knoll, who worked for him.
And Knoll became important.
Yeah, Hayes was closer to Schwartz's age, also interested in technical analysis, charts, patterns, volume. So they clicked.
So what happened?
Schwartz started taking these long lunches from his analyst job at E.F. Hutton. He'd go down to the exchange to visit Hayes.
Quotation marks noted. So reconnaissance missions.
Totally. He was studying the place, learning the layout, who was who, how the specialists operated, the whole flow, getting the lay of the land before he jumped in, like prepping the battlefield.
Smart. Doing his homework. And all this time, he's still officially an analyst at Hutton.
Yeah, for almost a year, his analyst job was becoming, let's say, secondary. He'd go to his office, shut the door, and fire up his own bunker Ramo, quote, machine.
His own machine?
Yeah, that was crucial. It gave him real-time prices. He'd actually negotiated getting one in his office as a condition when he took the job at Hutton. Clever.
So he could trade discreetly from his office.
Exactly. Monitor the market, place orders, all while looking like he was doing his analyst work. He knew timely information was everything, and he didn't want colleagues or bosses looking over his shoulder.
That bunker Ramo was his secret weapon. Why not just use the one in the research department?
Oh, well, he mentions that usually there was only one machine out in the open. If he was constantly checking it, people would get suspicious, right? Having his own machine gave him privacy, maintained his cover while he was prepping his exit strategy.
Okay, so strategy, reconnaissance, and saving up that $100,000 grubstake. How did he pull that together?
A lot of discipline, saving hard. And Audrey was crucial there, too, managing their finances. They really tightened their belts.
But there was also a gift.
Yes, a big help. $50,000 from his in-laws. He called it his Dumbo's feather.
Dumbo's feather?
Yeah, like a psychological safety net. Something that gave him confidence, but he was absolutely determined never to actually use it. Dipping into that would have felt like failing, you know? He needed to feel he'd mostly earned his starting capital himself.
Interesting psychology there. Now, before all this Wall Street stuff, he had some early experiences with gambling, didn't he? Even as a kid.
Yeah, it seems risk and reward were always part of his thinking. Flipping baseball cards, playing card games like setback and poker, going to the Aqueduct racetrack.
He was having fun, or was he learning something?
He definitely drew lessons. He explicitly says preparation pays. Even back then, he realized you needed to know more than the other guy to have an edge. That idea stuck with him.
And he kept up the interest in horse racing at Amherst, took a gambling trip in Europe while he was in the Marines.
Absolutely. These weren't just casual flings. They seemed like part of his informal education and risk assessment, understanding odds, managing losses, reading situations, sharpening that intuition.
He even mentions dealing with a bookie, Maple. Adds a bit of an illicit thrill, he says.
Yeah, exposing him to another side of wagering, maybe the high stakes involved.
Okay, so fast forward a bit.
Yeah.
Before the trading floor, he had this career in institutional research. Kuhn Loeb, the Great Pyramid. What was he doing there?
At Kuhn Loeb, he was mentored by Abe Bronstein, focused on healthcare, drug chains specifically, and he learned pretty quickly that a big part of the job was writing positive research.
To attract investment banking business.
Exactly. Positive recommendations could help the firm land lucrative deals. It was kind of a built-in bias, you could say.
But then, at the Great Pyramid, things took a different turn with the hospital management industry. A negative call. That sounds risky.
It was hugely significant and, yeah, ultimately very risky for his career there. A colleague, this guy he calls the Sphinx, flagged that the valuations for these hospital companies were getting way too high. Unsustainable.
Why?
Potential government regulation was looming, could really hit their profits. So Schwartz and the Sphinx worked together on a negative report, arguing these stocks were massively overvalued, should be treated more like utilities with lower PE ratios.
Going against the grain, how did that land?
Well, initially the firm didn't really push it. Negative reports don't usually win you investment banking clients, right?
Makes sense.
But somehow the report got out, leaked by another analyst, Paul Standish. And that caused a huge storm.
How so?
An internal investigation started at the Great Pyramid. And worse, one of the companies they slammed in the report, American Medical International, or Uranus as he calls it, sued them.
Ouch. Major headache for the firm and for Schwartz.
Big time. The general counsel basically warned him his interests and the firms might diverge. And even though Schwartz wrote the analysis based on his research and didn't leak it,
He still faced the fallout.
yeah, negative press, the lawsuit, and ultimately they let him go, dismissed him.
Wow. For writing a report they initially didn't even promote.
It was a harsh lesson, right? Challenging the consensus, even if you think you're right, can have serious consequences in that world.
Definitely a tough break. Okay, let's pivot a bit. He talks about rumors inside Skinny and his fascination with gold. What's inside Skinny?
It's just that world of market whispers, tips, unofficial information that flies around. Schwartz admits, even though he believes in hard work and analysis, who doesn't listen to a good rumor sometimes?
But you have to be careful.
Exactly. He stresses vetting your source. Does this person usually know what they're talking about? Give more weight to credible sources.
And his thing for gold. It seems deeper than just liking shiny metal.
Oh, it's deeply personal, tied to his family history. His grandfather, Sam Schwartz, fled pogroms in Eastern Europe. For people like him, gold was real, tangible wealth you could carry, something safe when everything else collapsed.
So, a symbol of security.
Yeah, his grandfather hoarded gold coins during the Depression, too. It just instilled this fundamental belief in Schwartz about gold's value, especially in uncertain times. He collected coins himself, dreamed of double eagles.
And this belief led to a pretty dramatic moment involving the Mexican peso.
Yeah, that was intense. He heard news suggesting the peso might collapse, and he just had this immediate, visceral reaction, convinced it would trigger a global panic, a flight to safety.
So what did you do?
He frantically called Audrey, told her to go to the bank right now and withdraw all their physical gold, like all of it. Sounded like utter panic.
Audrey must have thought he was crazy.
Pretty much. She was apparently quite taken aback, trying to deal with weekend plans while he's yelling about gold. But it just shows how deep that gold as safe haven belief ran for him.
Vivid picture. Okay, let's talk about futures trading. He gets into that too. And the role of tax straddles is interesting.
Right. He makes the point that exchanges, fundamentally, are like casinos. They make money on volume, on the fees from trades. And back in the early 70s, the big Chicago exchanges, the CBOT and the Merc, they were struggling a bit to get traction with traditional commodity futures.
Like corn and soybean.
Yeah, that kind of thing. They needed new products, new players. So the Merc launched currency futures. The CBOT brought in Richard Sandor, who's really innovative, and they developed financial futures, like T-bond futures.
Wall Street wasn't biting initially.
Not really. The big firms were comfortable with stocks and bonds. It took something else to really draw them into futures in a big way.
And that was tax straddles.
That was the catalyst. Tax straddles were this complex strategy, became very popular for high-income folks near year-end.
How did they work?
Basically, by buying and selling offsetting futures contracts, you could create paper losses in 1 year to offset real gains and push the corresponding profit into the next tax year, deferring taxes.
Sounds useful.
Hugely popular. Brokerages set up whole departments just for this. It didn't change the underlying economics, but it generated massive trading volume for the Chicago exchanges. Huge commission business.
But the IRS wasn't going to let that go on forever.
No way. They cracked down. And the Chicago exchanges saw this as an existential threat, basically. They fought back hard, lobbied Congress.
And they had allies.
A powerful one in Dan Rostenkowski, the Ways and Means Committee chair, a Chicago guy. He helped protect the futures markets.
And even after the straddle crackdown, futures still had some tax advantages over stocks.
Generally, yes. For active traders, the tax treatment on futures profits often remained more favorable, so that incentive was still there.
Okay, so that's the backdrop. Schwartz decides to jump into futures, opens an account with Spear, Leeds, and Kellogg. How did that start?
He used treasury bills, T-bills, as collateral for his margin account, which really highlights the leverage in futures, right? A small amount of T-bills let him control a much larger position value.
And he had someone on the floor.
Yeah, a clerk named Debbie Horn on the floor of the New York Futures Exchange. They called it the Knife. She had direct lines to Chicago, too, to the Merc and the CBOT.
So he's still mainly trading Amex options, but experimenting with futures now. What did he notice early on?
He started trying different things: gold, euro dollars, currencies like Swiss francs, Deutschmarks, T-bonds, just getting a feel for them.
Any specific insights?
One interesting one was seeing a potential link between how T-bond futures traded after the main session closed and how the S&P 500 index would open the next morning.
Like a predictor.
Sort of. He saw this pattern where the overnight T-bond move seemed to give a clue about the S&P Open. He even made his first S&P futures trade based on that observation. Made an instant paper profit, shows him constantly looking for an edge.
Always looking for those little signals. Now, he starts thinking of himself more as a market timer. There's an incident with ASA options, the South African gold stock. What happened there?
Right. ASA was super volatile, tied to gold prices, inflation fears. He was trading its options actively. And he describes this one time where he just abruptly flipped his position, went from long betting it goes up to short betting it goes down.
And that upset someone.
Yeah, another trader, Jerry, apparently got quite angry. But Schwartz used the analogy of a switch hitter in baseball. He was realizing he needed to be flexible, play both sides of the market up and down.
Which is key for a market timer, right? Trying to catch those shorter swings.
Exactly. He contrasts it with buy and hold, which is often advised for regular investors. Market timing needs that ability to go long and short, constantly practicing, staying sharp.
And this period seems pretty successful for him. He felt he'd made it big time by his college reunion. But then, the never short a Republican disaster. That sounds painful.
Oh, it was a massive painful lesson. Came from, well, probably some overconfidence and just refusing to admit he was wrong.
What happened?
Reagan got elected. The market rallied huge. Schwartz thought, okay, this is way overdone. Time for a pullback. So he went short S&P futures. Big time short.
But the market kept going up.
It just kept climbing, stubbornly. And even when the main S&P futures contract hit its limit up, meaning it couldn't trade any higher for a bit, the New York exchange, the knife, kept ticking higher.
So he was stuck.
He should have cut his losses, but he got irrational. He kept selling into that locked limit, digging himself a deeper and deeper hole. Just couldn't accept he was wrong.
How bad was it?
The losses piled up. $600,000, maybe more. A devastating blow to his capital and his confidence. Just wiped out a huge chunk of his gains.
That drive home must have been brutal. Did Zollner, his mentor, have any advice?
Crucial advice. Zollner was blunt, told him, cut the loss, and reminded him of that core trading truth. Your winners are ahead of you, not in back of you.
Don't dwell on the losers. Focus on the future.
Exactly. Stop trying to get back what's gone. Move on. A vital lesson in risk management and emotional discipline.
So simple, yet so hard to do in the moment. Schwartz admits he struggled with it himself later on, too, but this clearly hammered home the need to control risk. He did go on to win the U.S. Trading Championships, though.
Yeah, that was a big public validation of his skills, but he also points out how incredibly stressful those competitions were. The pressure took a toll on people.
It wasn't all just charts and trades, though. He had some odd personal hurdles, too, like that Park Avenue Co-op board interview.
Yeah. That story shows how some people outside finance viewed trading back then. The board was suspicious, saw it as just gambling, worried about his financial stability. A different world.
And he learned a very specific, very personal lesson about life events impacting trading around his daughter's birth.
Right. A $150,000 loss. He attributes it to the disruption, lack of sleep, maybe hormonal shifts affecting his judgment. A really human insight. Your personal life absolutely affects your professional performance, especially in high-pressure jobs.
He also mentions frustrations with the Chicago pits, something called slippage. What's that?
Slippage is basically the difference between the price you expect to get filled at when you place an order in the pit and the price you actually get.
Because it's so fast and chaotic.
Exactly. Your order might get filled a tick or two worse than you hoped, especially if you weren't physically in the pit yelling yourself. He mentions Leo Melamed of the Merck, basically acknowledging, yeah, that happens. Part of the game there.
So finding a good clearing firm was important, too. He ended up with Third LaSalle. Good relationship there.
Yeah, seemed solid, worked well with Debbie Horn again and the Marcucci brothers who ran it. But then that had a scare, too.
Really?
He found out Third LaSalle was in financial difficulty. Most of his cash was safe elsewhere, but he had $1.2 million in T-bills stuck there. Big risk.
What did he do?
Acted fast, used his knowledge of the regulations, the CFTC rules, maybe called in some favors, his clout in Washington, he says, to make sure those T-bills got transferred safely before anything bad happened.
Wow. Shows you need to understand the plumbing of the system, too, not just the trading. Interestingly, amid all this intensity, he and Audrey got into art.
Yeah, they developed a real passion for it, especially American Impressionism. Made some significant purchases.
He saw parallels between art and stocks.
He did. Finding a good painting, he said, was like finding a good stock. Required research, understanding value, having a discerning eye. They even successfully bid on a Hassan painting at Sotheby's.
But trading still delivered humbling moments, like his first time actually in the S&P pit in Chicago.
Oh, yeah. He went in feeling pretty confident, successful S&P trader over the phone. But the physical pit was a different beast entirely.
Gotta go.
Lost $90,000 in about an hour.
Ouch.
A swift kick. Huge reminder that different environments require different skills, and overconfidence is dangerous, especially in a new, super competitive arena like the Merck's S&P pit.
Then we get to 1987. The crash. He talks about being unable to take a vacation, trading even on Columbus Day.
Total dedication, or maybe obsession. As the market started that steep slide in October 87, he actually thought it had bottomed initially. He went long S&P futures, betting on a bounce.
Wrong way again, briefly?
Yeah. And then Audrey's reaction, his own gut feeling, it triggered that go for the gold instinct again. Literally.
Back to the bank.
Frantic trips, withdrawing huge amounts of cash, just convinced the whole system might seize up. That deep-seated fear of financial collapse kicking in again.
And then Black Monday hit. The Fed stepped in. He heard rumors the futures market almost broke.
Yeah, Inside Skinny was saying the whole clearing system was incredibly stressed, near failure, just unbelievable volatility.
But he managed to navigate it.
He did. Showed that adaptability again, got short for the rebound after the initial crash, made good money, and amidst all that chaos, Audrey's asking about her jewelry in the safe deposit box.
A touch of reality.
Right. And then his friend Ray gives him a baseball, kind of symbolizing that Schwartz had hit a home run, secured his family's future.
Moving ahead again, the Gulf War. He connected his Marine training to trading then.
Yeah, the discipline, staying calm under pressure, strategic thinking. He felt that training helped him during the uncertainty of the war.
How did he trade it?
Aggressively bullish on treasury bonds. Built up a huge long position in T-bond futures. USH is the symbol he uses. Believed the war outcome would be positive for bonds. Made quick, substantial profits. Also shorted euros at the same time.
His career wasn't short on colorful characters either. Porky, the angry money manager.
Huh, yeah. Just glimpses into the eccentricities and egos you find in that world. The Porky story is just bizarre. And the encounter with the manager offended by his fees, it all contributed to a realization for Schwartz.
What was that?
That managing other people's money, the whole fund management game, just wasn't really for him. Didn't suit his style, his desire for autonomy.
So he closed his fund, Sabrina Partners.
Yep. Liquidated it, called it a good trade in itself, knowing when to get out. Allowed him to refocus purely on his own trading.
And he even moved to Florida, partly to escape the intensity.
Tried to, yeah. Escape the constant pull, the addiction, as he calls it, of the New York trading scene. But he admits, even with therapy, it was hard to fully step away.
The pull is strong.
Deeply ingrained. The challenge, the intellectual puzzle, the rewards. Hard to just switch off.
Okay, so finally, looking back at these early years, he lays out some core principles. His early guide to successful trading. He stresses hard work isn't enough on its own.
Right. Hard work is fundamental, but you need more. He points to 5 key building blocks for his success.
Which were?
That gambling instinct he always had. Critical thinking from Amherst. The knowledge base from Columbia Business School. Performing under pressure, learned in the Marines. And crucially, Audrey's money management skills keeping things grounded.
And some technical tools he used.
Yeah, he talks about using exponential moving averages, EMAs, to gauge the trend. Basically smoothed out price lines to see the direction. He'd analyze daily and weekly charts, mark out key levels, support, resistances, pregame notes.
Preparing for the trading day.
Exactly. Planning potential buy and sell zones. He also mentions Marty Zweig's put-call ratio.
What's that?
It compares the volume of bearish bets, puts, to bullish bets, calls. Extreme readings can be contrarian signals. If everyone's super bearish, maybe the market's about to turn up and vice versa.
And his typical day included watching after-hours S&P trading, too.
Yeah, that link he saw early on between after-hours futures and the next day's open remained important for him, getting clues for the next session.
So, wrapping up this deep dive into Schwartz's formative years, what are the main takeaways for you, the learner, listening to this?
Well, I think we've seen just how crucial it is to develop your own trading methodology, something that fits you, not just copying someone else.
Right. And mentorship clearly mattered.
Hugely valuable. Having someone like Zollner for guidance.
Yeah.
Risk management that never short a Republican story just screams it is absolutely paramount. You have to control losses.
It also seems like constant learning and adapting is key.
Absolutely. The markets change. You have to change. Blend that discipline and analysis with maybe a bit of instinct, too. And it clearly takes immense dedication and the ability to handle a serious emotional roller coaster.
It's been a really fascinating look behind the curtain, hasn't it? Way beyond the sort of glamorized Hollywood version of trading. It's about discipline, psychology, hard work.
Definitely. Intense dedication, constant learning, navigating that relentless emotional landscape.
Yeah. And thinking about Schwartz's drive, that roller coaster.
Yeah.
It does make you wonder, doesn't it? A final question for you, our listener. Maybe chew on.
What personal qualities do you think are truly essential for navigating any field that involves significant risk and reward? What's your personal trading floor, so to speak, and what lessons from Schwartz's early days might apply there?
Some really good food for thought. Thank you for joining us on this deep dive into the world of Pitbull. If this sparked your interest, definitely check out the full book. There's so much more detail and insight in Martin Schwartz's own words.